Risk-off was seen across the board in the major US stock indices yesterday, as the Dow Jones, the Russell 2000, the S&P 500, and as well as the Nasdaq 100 all declined by -4% to -1.6% on the backdrop of a less dovish FOMC meeting yesterday. Based on the CME Fed Watch 2, taking into account of the Fed Funds Futures Market, interest rate cuts bets has been totally reduced for 2026. That means previously we have 2 interest rate cuts being penciled in for 2026. Prior to the FOMC meeting yesterday, we have 1 interest rate cuts, and right now there are 0 interest rate cut is being expected for 2026, and that also causes the US dollar to rally, where the US dollar index rose by 0.7%, retesting the key medium-term range resistance of 100.54 that has been in place since May last year. Given the surge of the US dollar and as well as oil prices that rose to 3 to 4% yesterday due to this back and forth retaliatory attacks between Israel and Iran, where Israel yesterday hit Iran oil assets, and right now Iran threatened to stage a reaction attack on Gulf states oil prices, that actually causing the oil supply shock to come back into the global markets again, rising the fear of stagflation, where gold plummeted below its 50-day moving average. Very good morning to all, and welcome back to today's volatile session in our Daily Dose of Market Insights. Today will be the Thursday, the 19th of March 2026. So before we kickstart the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for information purposes and it's not investment advice. Past information is not representative of future results. All right, so here we go. So like I mentioned earlier on, whatever rally that's being seen on the global benchmark stock indices are more like a mean reversion rebound. We in a potential medium-term downtrend phase because of this ongoing US-Iran war / conflict is not showing any sign of de-escalation, and the conduit is this stagflation fear due to rising oil prices, which in turn potentially could cause the Fed to tie their hands in terms of continuation of their interest rate cut cycle that took shape last year, pardon me. So let's take a look at the key events that has happened yesterday, which is primarily the FOMC meeting. But prior to the FOMC meeting, we do have one tier 2 US inflation data, which also caused market participants to reduce Fed rate cuts bets for this year. So what is this data? It will be we call it the PPI data, the producer price index in US. Take it away at this data is a proxy of cost of doing business in the US. So yesterday we have producer price data came in before the FOMC meeting, which is we call it the PPI. So the core PPI data actually rose to 3.9% year on year, way above expectation of 3.7%, and also above the previous January print of 3.5%. And if you look at the trend of the core PPI data over here, so this is the steepest rise in 3 years. So if you look at the trend in the past 5 years, okay, so for sure it starts to actually bottoming up since the low of 1.8% in December 2023. So this particular PPI price, if it continues to remain stubborn or bottoming up, that could also potentially see a push of I call it a cost push impact on the CPI data as well. So that being said, over here is that we now starts to see the US Federal Reserve officials thinking. They upgraded their inflation expectation yesterday. So yesterday, no change in the Fed funds rate. All right. So what we could see over here is that that is in line with market expectation. Right. If you look at the FOMC, we call it outcome. So the FOMC outcome over here, the Fed interest rate decision was the same, okay, at 3.75% over here. So what's interesting over here is that the dot plot, right? So the dot plot, let me go to the dot plot now. Okay, point size is a bit complicating. So we go to the website. think where is the dot plot website? I think, yeah, this is the one. I'll put it a while back. Okay, give me a minute. Okay, so now this is the dot plot. So let me expand my screen for you guys to have a better view of the chart of the thing. Yeah, I think hopefully this is big enough. Okay, good. All right, so this is the dot plot over here that will release in every 3 months. All right, so it's very important because this give us a bit of monetary policy stance guidance by the Fed in what are they projecting in the near future and in the long run. So what we could see over here is that the last dot plot was December, was in, where is it? The last dot plot was projected in December. All right, okay, hopefully, okay, I think it's hang. Okay, it's in December. All right, over here. Okay, the row is December. The upper one over here is the latest dot plot that was released yesterday. So December real GDP for US was at 2.3%, and yesterday it upgraded to 2.4%. Right, so there is actually a increase in growth expectation in the US economy. Very similar for 2007 as well, where in the December it was at 2%, it increased to 2.3% over here. And even in the long run, the Federal Reserve officials push it up to 2% as well, 2% growth. But what's interesting over here is that the unemployment rate all unchanged, but it's the core PCE inflation. All right, so core PCE inflation stripping out of those volatile items like food and energy. The US Federal Reserve official median forecast actually rose, all right, based on the latest March projection, which was released yesterday. So for previously in December, it was projected at 2.5%. So right now they push it up to 2.7%. So that's 2 basis point increase. Very similar for the 2027 as well, 2027. Previously was 2.1%. Core PC inflation trend was also upgraded in the year of 2027 up to 2.2%. For 2028 remains the same at 2%. So based on this movement of the upgrade of this core PCE, we call it a forecast or medium projection done by the US Federal Reserve official for 2026 and 2027, that indicate that the Fed is pretty much fearful about inflation trend remaining sticky. And they try not to actually spook the market by keeping the Fed funds rate projection the same as in December. So in December, at the end of 2026, they expect it to be at 3.4%. So it still remains the same at 3.4%. And bear in mind that the current Fed funds rate is 3.5% to 3.75%, the range. So from 3.4%, you minus 3.5% to 3.75%, that actually implies one interest rate cut that is being penciled in for 2026. Very similar for 2027 as well. They keep it at 3.1%, and for 2028, they keep it at 3.1%. All right, so that also indicate that in 2027, there could be one interest rate cut coming into play. Then 2027, all right, then 2028, they maintain stamp at 3.1%. And in the longer run, they upgraded the inflation trend, the Fed funds rate from 3% to 3.1% in the long run. So in the long run is, we talk about many years or more than 3 years. So what it means over here is that based on this US Federal Reserve dot plot latest projection on the core PCE inflation trend that got upgraded, that actually spoke market. And also because going forward, if we start to see this ongoing Iran-US war that is not showing any signs of de-escalation, so what we could see yesterday, both sides actually hit oil assets. All right, so what we could see over here is that Trump now presses for de-escalation because there are Iranian attacks on Iran and Qatar. So basically, Iran oil assets and gas facility got hit by Israel, and Iran reaction back and hitting Gulf states, so-called oil asset classes, oil assets as well. All right, in both sides. So that actually create uptick in global and gas supply shock, all right, and potentially increase the risk of stagflation. So with that, despite, even though the dot plot, right, didn't didn't actually changes in terms of the Fed funds rate projection. The CME Fed Watch 2 doesn't believe. That means, i.e., the CME Fed Watch 2 is actually taking into account of the latest price action in the Fed funds futures traders, Fed funds futures contracts. All right, so that means the Fed funds futures traders are not believing that the Fed will do an interest rate cut for this year. So how do we see that? By looking at the CME Fed Watch 2 aggregated meeting probability. All right. So now the current Fed funds rate is at 3.5% to 3.75%. So if you look down the calendar, so these are all the various next calendar for the next FOMC meeting. So the next meeting will be on the 29th of April 2026. So high chance, 95% chance the Fed funds futures traders is expecting the Fed to remain on hold again. 99% chance on the 17th of June meeting remain on hold. July meeting, 29th of July, 91% chance. And you look all the way down the calendar, October meeting, September meeting and October meeting, all very high chance that the Fed will maintain on hold, 78 and 73%. And prior to this FOMC meeting yesterday, there was actually a chance about 60% that the Fed funds futures traders is expecting the Fed to do a 25 basis point cut in either September or October. And right now, even in the December meeting, 9th of December, the last meeting for this year, that 25 basis point cut also got evaporated. Why? Because if you look at the 3.25% to 3.5%, so that will be the next Federal Reserve Fed funds rate and assuming a 25 basis point cut is being ignited on the last meeting of the year, that's only at 45% chance. All right, so 55% chance is expecting no change. That means what the Fed funds futures traders now are implying that there will be potentially no interest rate cut at all for 2026. And the next interest rate cut means the fourth interest rate cut in this ongoing interest rate cut cycle, where the Fed cut 3 times late last year, will only be penciled in on the 9th of June 2027, which has a higher chance of 69%. Right. So what we could see over here is that there is a dramatic shift in the market expectation. So this market I'm referring to is a Fed funds futures market in terms of how the Fed conduct their monetary policy. So it actually implies a very hawkish vibe that is taking shape in the marketplace right now. So that actually causes a sell-off in the US stock market. So if you look at the US stock market, we see a sea of red almost among all the S&P 500 component stocks over here, and only pockets of green that are more prevalent to this ongoing US-Iran war that benefit from it will be energy, oil and gas. Over here, we see some pockets of green in oil and gas stocks over here due to their sensitivity with higher oil prices, leading to a much more higher chance of positive net revenue for these energy companies. And industrial, because we have some industrial that is related to defense manufacturer of weapons like LMT, Lockheed Martin, which actually manufactured those higher grade warcrafts or warplanes that is being used by US and Israel in the this ongoing US-Iran war. And also we talk about this RTX core will be the manufacturer of this long-range missiles or something like that. Right, so we see some kind of pockets of green in those military / defense manufacturer for the industrial segment. So if you take it as a whole, as from a 11 sectorial grouping, so yesterday's daily performance, we only start to see very clearly the positive one in energy. If you take everything as a whole on the aggregate, positive 0.23% yesterday, and the rest of them are deeply in the red. All right, so what we could see right now is number one, a double whammy that is taking shape in the global markets right now due to stagflation fear. And because of this stagflation fear, we also see liquidity squeeze as the US Federal Reserve expectation now has of a 1 interest rate cut for this year has been erased to stampede. And if this stagflationary scenario narrative continues to take hold, there could be risk that the Fed may start to hike interest rate again. All right, so that is a very, very negative feedback loop for the global stock market. Okay, So now with that, let me share with you what has taken shape today as well. So today we have the Bank of Japan meeting. So the Bank of Japan meeting, no change as expected. So let me share with you guys. Okay, so what we could see over here is that, where is it? Today's Thursday. Let me go down the calendar. Okay, give me a couple of seconds. I think sometimes it's just got a hang over here. Okay, hopefully it's good. Yeah, so this is a bank of interest. So no change, 0.75%. So let's look at the statement, whether the statement has been released. Okay, so let me expand it. So they actually noted that in the statement that the financial markets has become more volatile and crude oil prices are rising sharply, warning that this development warrant close monitoring. Then they actually highlight that while core inflation may temporarily to dip below 2%, but however, it expect it to reaccelerate driven in part by higher energy costs. So overall, the statement reinforced a cautious but gradual tightening stance. That means no change at all. So policymakers balancing improving domestic condition against elevated external risks, including price shocks, FX volatility, and geopolitical developments. So that actually potentially could see a bit of support on the dollar yen, given that it's more like a balancing statement over here. It means they cannot be so aggressively hawkish at this point in time because of this negative feedback loop from stagflation fear. That means stagflation fear, we have slower growth and higher rates over here. So if the Bank of Japan to become very, very to what I call it, to portray a hawkish guardians, that there will be a upcoming interest rate hike in the next meeting that could actually tighten liquidity condition in Japan and creating a negative feedback loop on consumer and business sentiment, which eventually could see a much more faster down move in the Japanese stock market. So later I'll share on more about the intraday chart of the Nikkei 225 over here. So now let's take a look at the performance of the FX market so far. All right, so this is the 5-day rolling performance of the US dollar against other major currency. So what we could see over here is that initially there's a spike up of the dollar strength, and right now the dollar strength is now tumbling down. So if you look at the 1-day rolling performance, so what we could see over here is that in the 1-day rolling performance over here, the dollar starts to temper off. So after yesterday's push up in the dollar, we see the dollar strength tempering off a bit as we are speaking right now in the Asia session, 11:20 a.m. So this is the last 24-hour rolling performance chart of the dollar against other major currency, including the euro, Swiss over here. So what we could see over here is that the dollar yen is still relatively unchanged, negative 0.03%, some support coming in due to that rather balanced tonality as portrayed by the Bank of Japan monetary policy statement. And what we could see right now is that the dollar is inching down lower against the Aussie dollar, where the dollar is down by negative 0.33%, and in some form because of the weakness in the dollar against the Aussie, that is also being reflected in the cousin, which is the dollar against the Kiwi. So why the dollar is experiencing much more weakness in the Aussie dollar is because of a particular strong Aussie dollar data that is out today, which is the employment change data, the labor market data. So labor market data continues to be rather rosy in the month of February. So despite this back-to-back interest rate, despite this ongoing hawkish monetary policy guardians that is being portrayed by the RBA, it didn't actually temper off the labor market in Australia. So the employment change in Australia for February added much more jobs added than expected, because market is expecting 20.3k jobs added, but it jumped almost double 48.9K jobs added, and also surpass January jobs added figure of 26K. And the but because of this, but one thing to note is that the unemployment rate actually rose over here. So market expecting it at 4.1%, no change, but it inch up much higher by 2 basis points to 4.3% over here. And also at this point in time, market participants is also pretty much cautious in the FX market because there's two more risk event that is taking shape today, which is the Bank of England meeting and the ECB officials meeting right now. So later I'll touch on the expectation of the ECB and as well as the Bank of England interest rate decision expectation, and going forward, what is the market pricing it over here when I touch on the intraday technical outlook chart of the euro dollar and as well as the sterling dollar. All right, so with that, now let me actually take you through the situation right now in terms of, let's say, that why there is this stagflation risk coming to the market is because of this chart that I'm monitoring very closely from a longer term perspective. So if you look at this chart over here, is that for those who follow my daily dose on a very frequent basis, this chart is very important because it tells us inflation expectation in the US 5 years from today and 10 years from today. That's actually in line with the 5-year break-even inflation rate. So that 5-year break-even inflation rate derived from the US Treasury protection bonds market is implying what market is market participants in this market is expecting 5-year inflation trend from now. And the 10-year break-even inflation rate, which is in light blue, is telling us or implying what will be the inflation trend in US 10 years from today. All right, so if you look at both of them over here, the 10-year and the 5-year, so the 10-year is in light green, spiking up to 2.4% from the low of 23rd of February. All right, similar for the 5-year as well, also spiking up. So this spiking up in the 5-year, right, is the highest level that is being seen in February 2023. So that is what a 3-year high for the 5-year break-even inflation rate, spiking up to 2.66%, and the 10-year also spiking up to 2.4%. So you notice that right now this 5-year and the 10-year break-even inflation rate has now deviated very much more further away from that 2% Fed funds long-term, US Federal Reserve long-term inflation target of 2%. Then this rise in the 5-year break-even and the 10-year break-even rate is in line with the push-up in the US oil prices, which is the West Texas crude oil price. So like I mentioned, the main crux of what causes this ripple effect in the global markets, being FX, gold, and as well as the stock market, is all lies on how oil price move right now, or regarding the very fluid situation in the Middle East. So if this US-Iran war is not backing up pretty soon, both sides continues to play a game of thrones among one another. That could lead to oil supply shock. So the first oil supply shock before oil price could come down is we see a spike up in oil price first. So a spike up in oil price, stagflation fear. So stagflation fear, that would actually see inflation trend going forward in the near future and long term. That means the break-even rates going up further, and that could potentially cause the Fed to totally not cut rates at all. So that's being already expressed by the CME Fed Watch 2 for this year, where Fed rate cuts bets has been reduced this year to 0. And if this oil price continues to spike much higher at this level, that could potentially see the Fed thinking or considering interest rate hike this year going forward. So that would potentially see much more cascading impact on the global markets. All right, so that will be the first segment of the daily dose. So let me now move on to the second segment, which is the FX market segment. So before I touch on the individual FX segment, let me expand my screen over here. All right, good. So now the US dollar index first. Okay, let me touch on the US dollar index. So US dollar index yesterday did a strong bounce from our first support level, where previously was this swing high area of 15th of January, 3rd of March, and as well now March, where prices staged a strong rebound yesterday, up by 0.67%, retest its 100.54 key medium-term range resistance that has been in place since 29th of May last year, okay, where it's been stuck in this complex sideways range. So right now, since it's coming to the top of this range resistance, and right now we have a bit of risk event coming into the play today as well, which is ECB monetary policy meeting and Bank of England monetary policy meeting. Thereafter, there could be some profit-taking activities taking shape, where both of these key central banks, they may portray a bit of hawkish vibe going forward, given the higher oil price. Later, I'll share with you what is this hawkish vibes about. All right. So now let us touch on the ECB situation first. All right, over here. Okay. So this ECB. Okay. So the first resistance was not surpassed yesterday. Yesterday, we do have a bullish bias, right? So this bullish bias didn't materialize as expected, didn't hit our first resistance, and price action tumbled due to that dialing down of interest rate cut expectation by the Fed Funds futures traders. But where it stopped exactly at our key pivotal support lower limit at 114.55, if you could recall correctly, and did a bounce during today's Asia session, where the hourly RSI also exited from the oversold level. So market participants, why are they causing this bounce to take shape? Because of fear that the ECB may sound hawkish in their monetary policy guidance afterwards. Okay, so if you take a look at what market is expecting for ECB, is no change. Thereafter, no change. That means if you look at the ECB over here, deposit will maintain at 2%, right? But it's the concern about the press conference later at 9:45 p.m. Singapore time. So if you look at the current situation right now, market in the Eurozone, we call it the overnight swap market. So that is considered something very similar to the Fed Funds futures market, the short-term market. The traders are actually now betting 2 ECB hikes this year. All right, so much more hawkish than the Fed. All right, so traders bet on 2 ECB Fed this year. So traders in the swap market, that is a very short-term interest rate market in Eurozone, are fully pricing in 2 interest rate hikes from ECB bank this year due to fear of an inflation spike. So if that were to be portrayed by ECB President Lagarde press conference later at 9:45 p.m. Singapore time today, that could cause the euro dollar to gain a bit of strength going forward after yesterday's sell-off. So that actually explained to us why the euro dollar is bouncing right now, is because of a potential ECB that may turn hawkish today, right? As implied by the we call it the Eurozone overnight swap market, where traders in that market is looking for a potential 2 interest rate hike from ECB this year. That means total 50 basis point hike. All right. So with that, I will put this. That means the euro dollar potentially will today be stuck inside this zone. Yesterday's intermediate resistance level that can't surpass 115.65. Yesterday's support where it can't break below it at 114.55. So for today, I will have a neutrality stance on the euro dollar, neutral between 115.65 and 114.55. All right. Let's take a look at the sterling. All right. So Bank of England. Okay, let me delete this. Okay. So Bank of England will have their meeting much earlier than ECB. So ECB will be at 9:15 p.m. Singapore time. Bank of England 8 p.m. Singapore time. So market is also expecting no change at 3.75%. But however, in the UK overnight swap market, which is their short-term interest rate market, they are looking for some hawkish tilt in the monetary policy statement that were to be released together with the monetary policy meeting later. And right now, the short-term interest rate market in UK is now pricing in a 50% chance of a rate rise to 4% by December. That means what they are looking at a 25 basis point hike this year by Bank of England, because if you look at the current rates, it's at 3.75%. So potential pricing of 50% chance that the rate will be rise to 4% by December, implying a 25 basis point hike by Bank of England. So that being said, we see the sterling dollar also managed to survive right exactly at the lower limit of this short-term pivotal support that we have yesterday, where yesterday we do have a bullish bias. It can't hit our resistance level at 1.34 figure level before selling off. So for the sterling dollar as well, potentially due to this hawkish expectation as being portrayed and priced in by the short-term interest rate futures market in UK, potentially the sterling dollar may be trapped for today between yesterday's US session high before the sell-off. Yesterday's US session high before the release of the FOMC monetary policy dot plot yesterday, or FOMC Fed dot plot yesterday before the sell-off took shape. So that high was 135.50. So neutral between 135.50 and 132.60, which was the support that it managed to bounce off from it in today's Asia session at 11:32 a.m. Singapore time. So flipping to a neutrality stance between 1.3260 and 1.3550 for now. Next up will be the Asia Pacific currency, right? Starting with the Aussie dollar. So the Aussie dollar sold off yesterday as well. It hit below the 20-day moving average. But prior to that, at 2 p.m. Singapore time, it hit our first resistance zone at 71.20, 71.40. So yesterday we have a pivotal support at 70.15, 7015. So indeed, it managed to bounce off from this 7015, 7015 short-term pivotal support level. So with that, we do have a mild bullish bias for today. But first resistance to watch will be 70.80, which was yesterday's level that sold off before the release of the latest Fed FOMC dot plot, right? So that is at 70.80. So let me put it in writing. Okay, so over here, first resistance 70.80, only a break above 70.80 may potentially revisit 71.20/71.40 next. However, a bearish breakdown and hourly close below the key short-term pivotal support level that managed to find support in today's Asia session at 11:33 a.m. Singapore time as we are speaking, that would invalidate the mild bullish bias on the Aussie dollar and see further weakness to retest last Friday, 13th of March, key swing low area at 69.80, which confluence with the rising 50-day moving average. Breaking below the 50-day moving average will expose the 3rd of March swing low area at 69.44, slightly above the key medium-term pivotal support of 69.10. Right, so that's for the Aussie dollar. Lastly, will be the dollar yen. So the dollar yen managed to so far held within this medium-term ascending channel, minor ascending channel drawn from the low of 27th of February. And if you were to look at the hourly RSI, right now is also trying to bounce off from a former descending resistance, now turns into a pullback support over here, right? Or you could see on the hourly RSI. So indicating that upside momentum seems rather intact on the dollar yen right now as we are speaking. So with that, I will be, yesterday we do have a we call it neutrality stance over here. So I will use yesterday lower neutrality zone, which is the slightly higher 159.03. All right, so 159.03 right now is exactly the lower limit of this minor ascending channel drawn from the low of 27th of February and also yesterday's congestion area, Tuesday US session congestion area over here, right? That broke up during yesterday's US session, right? Before it did a pullback and it went up again, and right now it's trying to do a bounce as well. So first support level will be yesterday's US session low over here before the release of the FOMC dot plot release at 159.37. So next resistance to watch will be pretty much the previous intervention area, 160.23, 160.74, which is the upper limit of this minor ascending channel, and the 0.764 Fibo extension of this ongoing rebound since the low of 12th of February. And this 160.74, if you go back in time on the daily time frame chart, Over here is also previously the intervention level as well, where this area here created a massive sell-off in the dollar yen previously during 11th of July all the way down to the low of 16th of September 2024. So that was what, 1.5 years plus ago. And the key pivotal resistance level will be this if high here, this long term, 2nd of January and 11th of January. So that will be in 2026, 2024, pardon me, not 26, right? That will be the level of 161.70, 161.95. So this is the kind of a long-term pivotal resistance area. Breaking below 159.03 will invalidate today's bullish bias view to revisit this week low, which is Wednesday low at 158.60. Breaking below 158.60 will trigger off a minor corrective pullback sequence in the first step, exposing 158 figure level, followed by 157.40, which confluence with the rising 20-day moving average. All right, so that's for the dollar yen. Next up will be the global benchmark stock indices, starting with the Hong Kong 33. So the Hong Kong 33 was also very weak as well. Now testing our short-term pivotal support that we have yesterday. So what we could see is that it continues to print a series of lower high after a bearish reaction of yesterday at 2 p.m. Singapore time in this 20-day moving average over here. So, and right now it's trying to challenge to break below the 200-day moving average. So with that, two key resistance level to watch as we flip to a bearish bias stance for today on the Hong Kong 33 that is representing the Hang Seng Index, 25,800, maximum 26,147, which was the key swing high area of 11th of March and 17th of March. So as long as 26,147 short-term pivotal resistance is not surpassed to the upside, breaking below 25,385, potentially see further weakness on the Hong Kong 33 to retest the long-term pivotal support level at 24,765 in the first step. Only a clearance and an hourly close above 26,147 will invalidate today's bearish bias view to see a squeeze up towards 26,350, followed by 26,690 next. Next will be the Japan 225 that is representing the Nikkei 225. So the Japan 225 also yesterday it failed to have a proper breakout above the 50-day moving average, which is 54,900, and did a reintegration back below it. The hourly RSI now is breaking below a parallel ascending trendline support. Now turns into a pullback broke down, turns into a pullback resistance. So with that, yesterday we do have a short-term pivotal support at 53,066. So given the state of the hourly RSI, it's not so rosy at the moment in time. And if you look at the current graphical, we call it trend line, they're also been taken down as well. Taking into account of here to here. Okay. Okay, it has also been broken down as well. All right, this trend line support from the low of 9th of March. So with that, I'll be using 54,900 as my short-term pivotal resistance level for today, flip to a bearish bias on the Japan 225 that's representing the Nikkei 225, breaking down below 53,066, exposes the 9th of March key swing low of 51,055 over here. So that's for the Japan 225. Next will be the Germany 30. So the Germany 30 yesterday, we do have a bullish bias, hoping for it to do a mean reversion rebound towards 24,162, 24,350. That dematerialized and price action broke down below our short-term pivotal support level at the 23,280 mark over here. So it seems to us that price action now is attempting to resume this downtrend phase that has been in place since 27th of February over here as it continues to trade lower. All right. So if you were to do a channel, a potential descending channel, Okay, this could be the potential trajectory of the Germany 30. Okay, so with that, taking things one step at a time, this is the upper limit of the channel, the ascending channel, which will be my upper limit of the descending channel, pardon me, of upper limit of this minor descending channel, drawn from the high of 27th of February, also confluence with this graphical resistance zone here of 23,660, 23,805. All right, so using 23,660 slash 23,805, that will be my key pivotal resistance zone for today. Flip to a bearish buyer stance, breaking below 22,970 exposes the next support area that's very close to the 9th of March 2026 swing low, 22,687. That also confluence with the way back over here, the congestion area of 1st of April and 30th of April last year. Okay, only a bullish breakout back above 23,805. That also break out above the minor descending channel resistance, the minor descending resistance upper boundary, that could revisit that potential mean reversion rebound scenario again to retest 24,162, 24,350, which is the zone and confluence between the 200-day and the 20-day moving average as well. So that's for the Germany 30. Next will be the US Wall Street 30, representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average broke down, didn't surpass our first resistance level that we have at 47,460 level. All right. So what we could see, it continues to remains in this minor descending channel that I drew from the high of 26th of February. So yesterday, you also have a daily close below this former long-term pivotal support at 46,330. Okay, so this is a long-term pivot support. Oops, sorry. Okay, and also broke down below the key 200-day moving average, indicating that this mean reversion rebound that we have earlier on Monday is game over. And right now, a potential medium-term downtrend starts to unfold for the US Wall Street 30, that's representing the Dow Jones Industrial Average. So for today, I'll be using the 20-day moving, the 200-day moving average, and as well as the upper limit of this medium-term descending channel, upper limit of this minor descending channel, pardon me, from the high of 26th of February. That will be a zone of 46,710, 46,973. So 46,710, 46,973, that will be my short-term pivotal resistance level. Flip back to a bearish bias view. Next two support level to watch: 45,780, 45,237, 45,190. Only a squeeze up above 46,973 that will invalidate today's bearish bias view to see the mean reversion rebound scenario revisiting or reasserting itself again to expose the next two resistance level at 47,460, 47,800. Similar on the SPX 500. So the SPX 500 also broke down, okay, over here, our support level, and also now attempting to break down below the 200-day moving average as well. So with that, it also now starts to be evolved or oscillate within a minor descending channel from the high of 26th of February. So using a short-term pivotal resistance level at 6,720 over here. So 6,720 short-term pivotal resistance, flip back to a bearish bias view on the SPX 500, breaking down below 6,610, 6,585, which is the key swing low of now March, that could expose the next near-term support level at 6,535, 6,500. Only a clearance back above 6,720 will see a squeeze up to retest the upper limit of the descending channel resistance and also the swing high area of this Wednesday, yesterday before the US session start, 6,755, 6,755, 6,775. Clearance above 6,775 will see a further squeeze up to reignite the mean reversion rebound scenario again to expose the next near-term resistance level at 6,815, 6,848. Lastly will be the Nasdaq 100. So the Nasdaq 100 also tumbled below, and right now is retesting the 200-day moving average. So with that, we will have a pivotal support level. Yesterday's pivotal support level now turns into a pivotal resistance level, 24,710, 24,800. So as long as 24,700, 24,800 short-term pivotal resistance is not surpassed to the upside, potentially there could be a revisit of 24,350, 24,280. Breaking below 24,280 exposes further weakness towards 23,944, 23,840, which is the minor swing low area of 9th of March. Clearing above 24,800 will revisit the yesterday's swing high area before the start of the US session, 24,990, which is so confluence with the medium-term descending resistance from the high of 28th of January this year. Only breaking above 24,990 will potentially see a mean reversion rebound again back towards this choppy range configuration on the Nasdaq 100, that it continues to chop within this kind of complex sideways range since the low of 6th of February. So the next resistance level to watch will be 25,107, 25,192. Then breaking above 25,192, potentially revisit the choppy range resistance upper limit over here. Okay, at 23,396 or 25,396 or okay, so that will be the Nasdaq 100. Flipping to a bearish bias view for today using a short-term pivotal resistance zone at 24,710, 24,800. All right, so next up will be the commodities market over here. So let us go to the commodity market, which is gold XAU/USD. So still recall that gold yesterday we were neutral, but I do want of a potential breakdown because of the stagflation fear. So the breakdown, they took shape. It broke below our neutrality, lower limit of the neutrality zone with the 50-day moving average at 4,960 over here. So right now, potentially there could be a revisit of this medium-term ascending support from the low of 28th of October at 4703, 4655. All right, so with that, I will be using this pullback of the former 50-day moving average, which is also the pullback of the yesterday's lower neutrality range at 4,960. So using 4,960 as my short-term pivotal resistance level, flip to a bearish bias view for today. Next near-term resistance zone to watch will be at 4703, 4655. And if you do a projection based on the channeling, come on. Okay, a minute. Yeah, so if you do a parallel descending channel, that is oscillating right now, that also confluence with the lower limit of that channel, this minor descent channel from the high of 2nd of March, and also the 1.236 and 1.382 Fibo extension on this ongoing decline that has been in place since 2nd of March as well. Only a clearance and a breakout above 4,960 and hourly close above this level that would invalidate today's bearish bias view to see a squeeze back up again towards yesterday's high at 5,045. Above it sees a retest at the 20-day moving average at 5,125 over here. All right, so that's for gold XAU/USD. Lastly will be the West Texas oil over here. So the West Texas oil yesterday bounced over here, and what we could see is that the RSI has found resistance again at the 67 level. So for today, there could be a potential chance of a sideways range configuration. But this side range configuration, I do have a bias towards a bullish breakout given that the price action has remained resilient in a sideways range configuration since our low of Monday, and yesterday it almost hit our first support level at 92.60. Yesterday printed a low. Okay, let me expand the screen. Yesterday it printed a low of 92.72, and this 92.60 right now is also confluencing with the minor ascending trend line that price action managed to help in the previous sell-off since the low of 26th of February this year. So yes, I have yesterday we do have a bearish bias hoping for it to break below 92.60, then thereafter testing 88.36 maximum before another impulsive upmove sequence take shape. But based on the latest price action, my probability of breaking below 92.60 is much lower now. So I will flip to a neutrality stance for today first between 102.25 and 92.60, but tilting towards more of a bullish breakout above 102.25 for it to head up towards higher, towards 111.28, followed by the 4-year high that was being made on 9th of March, 116.56/119.54. That also confluence with the one-time Fibo extension of this ongoing minor impulsive up move that has taken shape since the sell-off, hitting a key bullish reversal low on 11th of March. Only a breakdown below 92.60 will revive that minor corrective pullback view towards 88.36. Below 88.36 will see a deeper mean reversion decline to retest the rising 20-day moving average, confluencing at 81.85. So that's for West Texas crude oil. Flipping to a neutrality stance first for today, but having a bullish tilt towards a bullish breakout above 102.25. All right, so that sum up the intraday technical outlook on all the broad-based cross asset classes. A bit longer for today because I need to take you guys through the intermarket dynamics that is playing out right now in the global markets. So before we go, let's have a quick look at the economic calendar. Other than ECB and Bank of England, what are the things to look out for? Will be Bank of Japan Governor Uda press conference later. That will be taking place at 3:30 Tokyo time. All right, Tokyo time, 3:30 p.m. So Bank of Japan Governor Uda's press conference. So Tokyo is 1 hour ahead of us. So Singapore time will be 2:30 p.m. So that could influence the yen, dollar yen, and the yen crosses that is still holding above that key pivotal support at 159.03 that I shared you guys earlier on. Then what we have over here is that pretty much quiet other than the Bank of England and ECB decision later. Then if we go down the calendar, yeah, that's it for today over here. So tomorrow, Asia session, before the start of the daily dose, we have Bank of the China Central Bank, PBOC, interest rate decision. So very likely they will not move the loan prime rate for 1 year and 5 years. So that will remain the same at 3% and 3.5%. So that will be 9:15 a.m. Singapore time. So before we go, just have a quick recap. What is the timing for Bank of England? So Bank of England interest rate will be at 8 p.m. Singapore time. No press conference, but they will release the monetary policy statement simultaneously. Then we have ECB at 9:15 p.m. Markets expecting no change, but all important will be the ECB President Lagarde press conference, whether her tonality is in line with the Eurozone short-term interest rate traders that has started to price in 2 interest rate hike by ECB this year, right? That means that could bring up the ECB deposit rate to 2.5%. So that will be at 9:45 p.m. Singapore time. So with that, I'm Kelvin here. Do practice proper risk management given such volatile situation with all sorts of we call it news flow that are rather fluid that could actually change market within a couple of seconds because of geopolitical risk premium that is pretty much hard to forecast coming out from US-Iran war/conflict that is showing no sign of de-escalation right now. So have a great day ahead, and we shall speak again tomorrow. Thank you.